Now back to Alan. What about on the institutional side? How will the access to and cost of capital be affected over the next year? And is there anything investing platforms can do to encourage the infusion of new capital coming out of this crisis?
I think in the short term, it's capital markets environment essentially freezing up. On the long-term side, I think ultimately I tend to be a little bit more pessimistic about this than most. I think that it's going to take at least 6 to 9 months, if not 9 to 12 months, for capital to really start coming back into the sector. The reason for that is what the institutional world is waiting for at this point is for somebody to be the first mover, for them to kind of set a comp and to execute some trade that makes the world feel that the market's returning to some level of normalcy. I think ultimately a lot of this is going to be dependent on, in the short term to medium term, how much more government stimulus is pumped into the economy and whether that's going to continue to mitigate some of the damage that we would have seen, had it not been put into place otherwise. And I think in the long term, we're going to have to really wait and see what happens with unemployment before we can get a real handle on how the economy is going to recover from this. I'm not saying anything groundbreaking here. I think it's somewhat common sense or obvious to say that the longer this environment lasts, the more damage there will be done. Businesses are trying to hold on. Government has reacted as quickly as it possibly could, faster actually, I think, than any other time in history to implement some sort of stimulus to prevent damage. And I think we've kind of already seen the impact of that in the marketplace, or just the public equities markets, with how quickly they've rebounded from their drop-offs earlier in March. Whether or not they stay there or we're going to see them drop back off has yet to be seen. But I think kind of a couple of key components here. One is going to be the government continuing to pump stimulus into the economy. This is definitely an inflationary period, so the government's going to continue printing and providing support, and ultimately it's going to cause inflation, but hopefully the short-term to mid-term damage will be abated by that. And I think ultimately what we're going to have to wait and see is for warehouse lenders to come back into play and see where they execute. So what I mean by that is everything is always ramp up over time. So going back to February, early March, you had the institutional world that was getting 5-to-1 leverage, sometimes even more. You had large institutional warehouse lenders, whether they were Morgan Stanley, Credit Suisse, or anybody else, providing 80-90% leverage to funds, these private equity and hedge fund groups that were buying this paper. We're going to have to wait and see where they come back and how they execute and what their credit box looks like. And it's not going to snap right back. It's going to have to start at X and end at Y. And where I think that basically lands is where we were probably back in 2016, 17, when that type of capital first started coming into the space. So I think advance rates and leverage are going to be down probably closer to the 60 to 70% range, which means that those private equity and hedge fund groups need to raise more equity. That's a process. It's going to take time. So I think the net effect is that lending will continue to be a little bit more scarce than it has been over the last 12 to 18 months, over the next 12 to 18 months. And ultimately that impacts prices. It impacts borrowers and buyers' ability to transact and purchase properties, which will in turn affect comps, which will in turn affect how much product and inventory gets built. It's all very tied in, extremely complex macroeconomics. So it's difficult to say where we'll land, but I think that's a fair projection for what I see coming.